quick look at our special segment called Deep Dive, where we put the spotlight, the focus on one company. And today we're talking about Avenue Supermarts, the stock we are focusing on. It's been down 5% in 1 month and over 20% in the last 6 months. Hiral is joining us to tell us what is ailing Avenue Supermart. Is it the rise of quick commerce, Hiral?
Absolutely. If you see in terms of where D-Mart goes, it's the rise of the quick commerce which is coming in to actually, trouble them. Let's quickly look at what's happened with regards to shareholder wealth. It's disappointed shareholders, down over 45% from its 52-week high as well. Moving on, what are the key reasons why D-Mart is actually falling? Let's look at the key reasons. Firstly, the Q2 numbers have been below what the street was estimating. Secondly, the same-store sales growth, the kind of drop that has seen, that has been absolutely alarming. And the rise of e-commerce versus modern trade. This is one of the other reasons that we have been looking out for. Moving on, surging real estate costs, that's hurting. Higher operating costs is what is the niggling worry as well. And you have multiple brokerage downgrades that have come in. But let's quickly look at, how quick commerce is giving a hard time to Big Daddy. Clearly, from a growth perspective, if you see in terms of quarters and on a year-on-year basis as well, D-Mart has been falling as compared to Reliance Retail and Spencer's. Last couple of quarters, it is one of the lowest growth that we have seen. Moving from there on, if you see in terms of the same-store sales growth as well, that has been on a declining trend. It started off at 17.8 in FY19. It peaked in FY23 at 24.2, and now it's in single digits. In this quarter, we've seen at 5.5. So this is one of the other reasons that we have been picking up so far. Moving from here on, if you see in terms of D-Mart versus quick commerce, low price, yes, that is what D-Mart has. However, quick commerce also provides that aspect to some extent. But when you talk about convenience, time save and speed, D-Mart is a loser versus your quick commerce players from here on. Moving on, the other aspects that we're considering is with regards to higher real estate cost, the kind of impact that we're seeing. Now, they had planned to open around 45 new stores in FY25. However, their sales back, they've actually, expansion plans have slightly been put on hold on the back of higher real estate costs. Let's look at the other one. 68 crores is what they've spent per store in 2024 versus a 28 crore per new store in FY17. And they've only managed to add 12 stores in the first 2 quarters. So that tells you that there could be a miss in terms of where 45 store expansion strategy goes. Now, in terms of brokerages, you have a Morgan Stanley, which has downgraded. And if you talk about the target price, that has been reduced as well. Apart from that, JP Morgan, a downgrade to a neutral target price has been cut. Citi has a sell rating for a target of 3,350. In terms of other brokerages, Goldman Sachs, a sell rating for a target price of 4,050. Lastly, if you talk about the current business strategy, low price, cluster-based expansion, D-Mart Ready is where you're seeing gradual expansion in large towns, and that's probably faulty because they actually need to move to tier 2, tier 3 instead of focusing on metros, because metros are the ones which are relying on quick commerce. Digital presence is what they're missing. Omni-channel strategy is really not in place for a D-Mart, and their integration of the online ordering with the offline shopping experience, that is what is D-Mart is missing so far. Now, what is lastly? Will they be able to, counter the quick commerce players as well is what we need to wait and watch. Moving on from what is D-Mart missing, if you talk about the key concerns, will the brick and mortar work versus quick commerce? Large format stores moat is missing because their expansion strategy is something which is not coming at play. The number of stores is what they might miss. The narrative from the management is absolutely weak, which is a concern. Growth is an overhang. And now, whether is it time for D-Mart to change the strategy to get into quick commerce because they have the advantage of volumes in terms of procurement. That is the strategy that they can use for quick commerce as well. And the commentary that we've been talking about, what they've said is that the growth of online grocery format is affecting the company's performance in large metro stores. So that tells you that they are sure that there is some trouble. We clearly see the impact of online grocery formats, including D-Mart Ready. Their sister concern itself is giving them some trouble, which is a part of their consolidated numbers as well, in large metros and the D-Mart stores, which operate at a very high turnover per square feet of revenue. In fact, D-Mart Ready business grew by 21.8% in the first half of FY25, and the company does not intend to do any quick commerce. They think that their model is pretty robust, and the learnings have been to try and get more and more revenue in the large towns and cities. This is what the CEO and MD has indicated as well. So yes, there is trouble in paradise. Where from here and whether they're able to meet competition in quick commerce format is what we need to wait and watch and see, because it is expensive as well.